Hello, everyone. Thanks for joining today for the last week in Mortgage Today. We are having some technical difficulties behind the scene. We're trying to get Faith Howard Mooney on to join us here, but in the meantime, we'll just kind of let everyone get connected and we'll get started here shortly. Sarah, how are you? How has your week been going?
Good, good. The sun's out today in Michigan, so we are having a better day here.
Awesome. I am ready for summer. I hope you all are too.
Definitely. So it is supposed to rain all weekend here, at least in the Grand Rapids area, so not good.
No, that's no good. So we have today on the line with us, Sarah Smith from Mercantile Bank. And Sarah was recently promoted to a new position. And Sarah, what is your new title?
So starting about next month, I will be the engagement and learning director for the bank. So I am leaving the mortgage industry. So this may be my last hurrah in
My
mortgage.
last year on mortgage. Awesome.
And unfortunately, probably not one of my last TMC conferences was Chicago, unfortunately, which was super fun.
Well, that is a bummer. We'll have to sneak you in
Yeah,
at,
that would be great.
at a later date. So, hey, Faith. Hey, Faith, can you hear us?
Yeah,
Awesome.
it's sweating a little bit there, girl. Sorry about that, everyone. Thanks for joining us today. I am having a week of some technology related issues related to Teams, and it apparently has even impacted my ability to have sound in Zoom. So I apologize, but thank you for joining. Sarah, I don't know if they introduced you already. Did Ashley already introduce you to the crew here so that they know who you are?
Yeah, we talked about the future, but I am currently the mortgage operations manager for Mercantile Bank.
Yes, and we are so happy to have you with us today. I know we convinced you to do this with us. And then for the first time ever, we have some technology issues on the front end of this. So I apologize for that. Thought we would kind of like, you want to, that's who you are. You want to say a few words just about Mercantile?
Yeah, so Mercantile Bank is based in Grand Rapids, Michigan. Our headquarters are here where I am located. We are an asset size of about $4.9 billion with about 45 banking offices. Recently, we have expanded, or I would say recently, a couple years ago into the Ohio market with a production office in Cincinnati and have a couple lenders on the mortgage side down in the Cleveland and all over Ohio. So super happy for that and thankful for the TMC message boards for connecting me plenty of times with servicing and other questions related to our expansion down there. So it's been great to have TMC on board as we have some really basic questions that have been super helpful to get answered.
Well, that is awesome. Glad that the team could help because that's what we're here for.
Yeah,
So
it's been awesome.
let's get started a little bit today. I thought, we're rolling into the weekend that is like Mother's Day weekend. So I thought we would kind of get started with that approaching, talking about an article that I read that was in Forbes this last week. For those of you that want to read it, you should, because it has some really great information about the people that are leading the government agencies that oversee primarily everything related to the housing market. And for the first time ever, it's 4 women. Amazing. I don't know, I'm sure you've seen that, but it's Marsha Fudge, Sandra Thompson, who has been a great supporter of TMC and was even at one of our conferences. For Ginny Mae, it's Alana McCargo, who happens to be a friend of one of our owners at TMC, and Julia Gordon, who, if you all missed it, you missed the best 12 days of TMC session that we had where she spoke, and it was the highest rated session that we've ever had.
Wow.
So how do you feel about that? 4 women.
I think it's really exciting. And I think also just, as you said, as a participant in different events and things, I think the accessibility of them has been impressive as they agree to, record the videos even for the article and different things across the industry. I think it's great to be, relatable. You talked about, Mother's Day and all of that great stuff. But just, I don't know, if there's a warm fuzzy about it, a warm heart, I think that's a great way to put it. And they're just, sort of no nonsense ladies taking charge of a bunch of very different important areas. So that to me has been very impressive and great role models for people to look up to, definitely in the, from the young lady side or the older lady side now, I guess I am.
I'll take that one too. I think
Yeah,
that's
yep.
impressive even from the older lady side, you have the young lady side. I'll take the old lady side.
Yeah.
Yeah. So, in looking at that, I mean, they're in at a time where our industry is under a little bit of stress. For $45.3 trillion market. And the one thing that we have heard, which we'd love comments from anybody also in the audience, so give us some chat out there. They have seemed like they legitimately want feedback.
Definitely. Yeah. And
Yeah.
I think you see that, like you said, at the panels and different discussions they're a part of, as they answer questions, you can see that they're super passionate about it. You throw out some, different statistics for us, but whether it's housing or rentals, I think that they take a great interest in it and show compassion and are actively doing things to make it a better either market for buying or in some cases renting. So that's been awesome to see.
Yeah, I agree with that as well. And like I said, they've been highly participative in some of our stuff, which has just been really great. And welcome. I think everybody in the industry kind of needs to be heard, especially when it's a hard time and wants to be heard. And so I think that that's great that they have definitely brought that in, and I think made a lot of people feel a lot more comfortable about what is going on. In the news this week also was for FHA borrowers can now get a 40-year mortgage modification. And I think it was something that was implemented, but share with me if you've had any experience with that.
Yeah, we don't generally service FHA loans here. We do a lot of modifications for the Freddie and Fannie space, but reaching into some of the research on it, it really cements some of the earlier points. If you dipped into the articles about the ladies and some of the initiatives for them, a lot of it talked about, and some of the comment, if you read the FHA ruling for it, just talked about the benefits of the 40-year modifications, helping borrowers build wealth through homeownership, which I think is a lot of our goals here. And whether that's, keeping people in the houses longer as a servicer at Mercantile, I think that's, something that was brought up even, at the MBA servicing conference I went to in Orlando that some folks might have been at. But if you think about it, the goal of a servicing department, hopefully in a loss mit department, is to keep someone in the home. And if you can do that with a 40-year modification, I don't think that's a bad idea. A commenter said that borrowers' credit is harmed by a foreclosure and often preventing foreclosed borrowers from regaining homeownership in the future. So whilst to some it may seem, a little bit crazy to go 40 years on a mod, I think it makes great sense if you're trying to allow people to retain their homes. One thing also is I was, doing some research for the podcast today. Just a quick Google search will pull up some of the rules about the 40-year mods. And what I found really interesting and a great perspective when you're thinking about some of the guidance changes is to read the comments. I think they said they had, 20 something comments on this that were provided, and there was reactions to it. Again, I talked about, building generational wealth was one of them. Long-term wealth, a shorter loan term allows for quicker wealth accumulation, all of that good stuff. And of course, a bit of a lower house payment, which, most people think is the primary goal in some cases of a modification. But I don't, I very pro keeping people in homes, as we all should be in this industry.
Absolutely. The information that I read, it seemed like it was geared towards helping people stay in homes.
Yes.
So people that were on like that brink of possibly having to give up their home, but then they go into even higher price rental potential properties. Doesn't make any sense. I hadn't even thought through the impact to their credit, which is a huge one for some of these individuals that have struggled to get into the home in the first place, right?
Right.
The other thing that I kind of came across talking about that is the goal is to reduce their mortgage payment by 25%, which it should do, but with rising interest rates, it's probably, a little bit less than that. But who wouldn't want to reduce their mortgage payment by 25% if you were struggling? I mean, it's got to be one of the largest bills that anybody pays
Right.
in a month. The other thing that I didn't think about because I was focused on the people getting the actual loans, but it also changes to keep somebody in a home. It has such a positive impact on the neighborhood.
Definitely.
So by helping people get that 40-year, stay in it, you don't have the negative impact in a neighborhood potentially of a foreclosure for everybody else that may be struggling to stay in the neighborhood as well.
Right. And as someone who hasn't done too much in the loss mitigation and foreclosure space, I know just enough to be relatively dangerous that it takes a lot of time and effort to go through a foreclosure. There's the required inspections, there's the required mailings and, attorney's fees and things. And it seems, pretty simple maybe to my my small brain here that, if you can keep someone in the home, even if it takes longer to pay off, the banks are still making some interest on it. You're helping a family stay in a home. You're not putting someone else back in the rental market. And you're, like you said, you're keeping the neighborhood, hopefully with a steady homeowner in there continually.
Yeah, agree completely. I think that is, well, for me at my age, a 40-year mortgage sounds like an awful thing. But it's like I think in times like these, we have to kind of go into things with, it's not necessarily permanent. Things are not necessarily permanent. Things are going to change. You're going to be able to change things. So I think that that is great as far as keeping people where they should be in their home. So this last Wednesday, of course, we got another 25 basis point increase in rates. No surprise to anybody. Don't know if we need to talk about that a lot. One thing that really stuck out to me was the fact that the language was different in this instance. And I think it was Kevin Peranio, I could be wrong, but someone that's within our TMC family that I listen to their podcast quite frequently, I think he pointed out the fact that there was a rate, it went up, but what was omitted was there was the statement of some additional policy firming may be needed that was left out of this statement. So I'm not going to ask you to predict, but is that an indicator at all that we're kind of like done and over with that? I think that's what people are kind of speculating on a little bit this week.
Right. Is vague or omitted language, better or worse for people's minds and their predictions and all of that. So yeah, I would totally agree. That was an interesting way to phrase or not phrase something.
Yeah. So we can now speculate for a little while while that is going on. It was the 10th increase in 14 months for anybody that's counting. I don't think that's surprising that's surprising to anybody. One of the other things that came out last week, which I think is really interesting, related to AI.
Yeah.
AI is the big term for the year, I think. And I'm not quite sure if there was something behind this, so you'll have to share if you know, that a statement was made by 4 federal agencies this last week that there is no AI exception to the laws on the books.
Yep.
Related to you have any insight into why?
Yeah, so this is curious. So I actually reached out to my compliance department on this because we were on a legal seminar the other day about the cloud and AI and all of this stuff. So I think a lot of it comes down to the algorithms with fair lending decision making and looking at some of the adverse action models. Reg B requires a creditor to provide the list of reasons for adverse action and requires the list to be specific and indicate the reasons for the adverse action. So the commentary just seems to indicate, obviously we wouldn't want to use, robots or AI, whatever we're going to call it, in the future for, many things, obviously, but I think it's just the CFPB reiterating, the opinions that, you can't use AI as an excuse, basically, is how I read this. The federal consumer financial protection laws and requirements should be enforced regardless of technology used by creditors. Just reading some of the press release that, for example, ECOA does not permit creditors to use technology that prevents them from providing specific and accurate reasons for adverse action. So creditors' use of complex algorithms should not limit the enforcement of ECOA or other federal consumer financial protection laws. And then also it makes super common sense to me that creditors can't justify non-compliance with ECOA based on the mere fact that technology they use to evaluate credit applications is too complicated or too opaque, or no one understands AI in the mortgage compliance space, and that creditors who are using these complex algorithms, including AI or machine learning technologies, there's no exception to breaking the law. You can't be unfair just because a robot did it, or AI did it for you, or something like that. So just making sure that people understand that you can't, the dog's not eating your homework, the AI isn't doing your adverse actions wrong. It's still the responsibility of the financial institutions to do it right, and don't try to play stupid, I guess is a way to put it. So yes, so I do have a thought on that, Faith.
Well said. I was
The Mercantile Bank Compliance Department for hooking me up with actually really interesting articles. And then it went a little bit, and I can share these with you too. She sent me some great research just about, fair lending and, this, and it got in, one of the articles got into a little bit about Facebook getting in trouble for targeted marketing years ago. And, all of the hullabaloo with targeted marketing and all of that stuff with AI, and just being extra careful and making sure that your all of that's being under the watchful eye of your compliance department. We're very lucky. We have a great team here, very connected. I told them I was going to be on the podcast. She sent me articles. So it was a great relationship. But make sure you're talking, if you're the one sending out the adverse action notices or doing anything with fair lending, that you are up on the press release and some of the commentary on it.
Yeah, I was thinking for some reason that was going to tie back into trigger leads.
Everything ties to trigger leads. We can talk about that again this week. People
all those are being used. That was where my mind initially went when I read that. It's like, oh, trigger leads have gotten a lot of great press, and now we get this statement.
Oh, I'm sure. Yeah, I'm sure there's certainly a way to tie it, especially if your trigger leads are, only triggering or targeting, if you're doing any sort of, minimize scope on that, I'd say you
slice and dice. Yeah.
Definitely.
I'm sure it does come into play there as well.
Definitely.
So also in the news, we always like to talk about young people in housing, or entering housing, gaining housing. I was reading a Redfin report that 30% of individuals who were 25 years old owned a home in 2022. I thought that was pretty high. Did you think it was high?
I thought it was really high, really high.
Me too. And that did also exceed homeownership rates for previous generations at that age. So I thought that was high as well.
Right.
28% of millennials, 27% of Gen X own their homes at age 25. Boomers, it says, had a homeownership rate of 32%. But I thought that was, in talking about, kind of, a new age of people coming into our industry, I thought that was really interesting.
Right.
The other thing so I like to watch people within our network and the things that they post, obviously. Keeps me in tune to what they're doing. So Scott Milner did a really great video a couple of days ago. Shout out to Scott Milner at US Mortgage Corp. That his whole video started by a statistic that he had found related to young people. It was high school students, actually. So, next generation even coming in after that. And it asked them what they wanted to be when they grew up. Anybody on this call have any guesses? I mean, share with us in the chat. Guesses on what 1 out of 4 high school students wanted to be when they grew up. Not real estate agents, not a realtor,
I wish it was appraisers.
Can we pick and choose? Oh, the other thing that it
Yeah.
should be maybe is, what was I reading that there was a shortage of? Oh, 203K, which we'll talk about next, 203K in that process. Maybe they could be someone that goes in there. A person that designs online gaming, great, great thing. Some of you are right. A number of you are in tune with everything that's going on. Phil, yes, you are right. Influencers, 1 out of 4 people in high school plan for their career to be an influencer. That was what their goal was. Bernard Nasuli, Chinese students wanted to be astronauts. US students wanted to be influencers. There you go. Focus on education. But yeah, so influencers was the answer. And so, what Scott was speaking of when in this thing was, how do you then, if that is their focus, then how do you gain their attention? Well, if they want to be influencers, who are they going to go to for knowledge? Other influencers, social media, all of those types of things. So any feedback or thoughts related to just kind of that statistic and, the next generation, not only coming into our space, but being homeowners as well.
I guess I'm not surprised. An interesting fact is we were talking to my niece who's 12 about her dream vacation. And her dream vacation was to go to Los Angeles to look for YouTube stars, which I thought was incredibly bizarre. I don't know if she thinks that these influencers are on every corner, and maybe they are. Haven't been to LA since influencers were a thing. But I don't think it's surprising. I also was surprised in, 6 months back, maybe it was, or, a little more than that. We heard about the 2-1 buy down or the temporary buy down being a popular TikTok topic, which is something that seems strange to me. And even myself, as I'm scrolling through, Facebook Reels, because I'm 41 years old and not TikTok necessarily, but it seems like there's a lot of information out there from influencers. And if they make it look easy, they make it look like you can, lounge at home a bit more and not have to go into an office and work a standard 9 to 5. And I think for a lot of young people, that's probably pretty appealing, especially coming off a couple years of, remote schooling or COVID schooling. I think it's definitely different than when I was growing up. I'm not going to say I wanted to be an astronaut, but I certainly wouldn't even have known what an influencer was. But not surprising, but also maybe a good thing that some of this info on, topics like saving and mortgage lending is being shared on the TikTok platforms. I don't think it's a bad thing as long as it's reliable information, and, legitimate financial institutions get out there and can give appropriate information and not just rely on maybe someone without an NMLS number to be teaching them about some mortgage basics.
Even if not mortgage, financial soundness. Financial
Yeah.
soundness is like such a great thing. And of course, if someone's relatable to you in some way, you're probably going to listen
Right.
maybe a little bit differently. I mean, I kind of equate it to being a parent and giving an answer, and somebody else can give the same answer, but if they're more relatable to your child,
Exactly.
they're going to listen to it versus you're just their parent. They're not going to necessarily listen to you. So I thought that was great. I thought it was good, kind of like food for thought and thinking about what is your marketing plan?
Right.
Where are you sharing things? How are you trying to attract people, not
Definitely.
only for mortgages, but maybe into your organization?
Definitely.
Kind of in all of those things. I just thought it was just a great way to look at something
Yeah.
with a different statistic.
And I think it's telling also that if 30% of 25-year-olds own homes, where are they getting their information? I'm probably guessing they're not walking into their local brick and mortar asking to sit down to talk through paperwork, which was something I did as a 25-year-old, but that was a long time ago now. So, but times are changing.
Yeah, times are changing, and it's just kind of an interesting way to like rethink things when you've been in the industry for a long period of time and are used to things being a certain way. I think we need to, as fresh people come in, hopefully they'll share those perspectives that they have with others. But I just thought it was an interesting way to kind of look at things. So Scott Milner, thank you for that thought process. It triggered all kinds of other thoughts going on in my mind. And so the other thing that we just mentioned, you wanted appraisers. I said, how about FHA 203K consultant? In the news this week, which I guess I was kind of surprised by and maybe shouldn't have been. But lack of 203K in a time where maybe people are trying to stay in their home, they've got a low interest rate, they're
Right.
not wanting to move, but they're wanting to make some modifications to their home. 203Ks are something that happen more at times like these. But looking for people,
Mhm.
lack of consultants. Had you heard this at all in the industry? And
I don't pay too much attention to that space. We do have a renovation loan, a second lien program that's been pretty popular because people have those first liens they want to protect. But as people want to stay in their homes longer because they do have those great first mortgage rates if they refinance through, some of the COVID stuff, I think it makes sense. But I also think part of the article that you shared was that, we need to find ways to make it a little more accessible. Even, for the past 20 something years I've been in this, the 203K has been just a very scary program, I think, for a lot of people. I know when I was reading the article, Jim was quoted in it, which was great to see his perspective on some of this stuff. But if you don't have an expert that does it, I think that's maybe one of the detriments also, that not all financial institutions or brokers do them. And then couple that with the fact that it's hard to do them and find the folks to, do the actual inspections and things. I think that's just a compounded problem, definitely.
yeah, it is very similar to, I know, I was in the appraisal space for 25 years. And I know when I left that space, which has been a while ago now, like the average age of an appraiser was 58 years old.
Yeah.
Average age. So that meant that there were many that were obviously older than that. It seems like this is a very, very similar situation, that maybe we should, begin to rethink how we change that process or attract younger people into our, it's time to get some of the new guard in place in some of these processes. So just thoughts for the week. And I can't believe it, but we're already at the bottom of the hour. So you survived. We
Woo.
knew that you would. We knew that you would, even with a little bit of a rough start. We appreciate you and all that you do within our TMC family. We love having you. You are, for anybody who hasn't met Sarah yet, she is like the funnest person to be around in mortgage. And so we always love that when we find that good, positive person who loves to share and talk with people, and appreciate all of you joining us today. So next week, back at the same time, same place. Thank you for joining us today, and look forward to seeing you next week. Thanks so much, Sarah.
Thanks, everyone. Have a good afternoon. Bye.